quite a unique security issue when it comes to the whole cryptocurrency world. And it's a combination of a number of things. Firstly, we all know, and that's obvious, that the signing key that's used to protect cryptocurrencies is all you need in order to steal everything. What's different from the standard classic setting of cryptographic key protection is that you don't need to steal the key. So classically, people have thought about protecting a key from being stolen. But if I just use the key that protects your currencies just once, I can transfer everything. So if you have a signing key that's protecting $10 million of currency, I don't need to actually steal that key. I just need to fraudulently use it once and transfer all of the money out. So it's a very different setting in terms of what we want to protect against. And the second thing which compounds this is that it's impossible to reverse any fraudulent transaction. Because it's a decentralized market, and that's actually what we want, the downside of that is that we can't detect the theft and then somehow roll back like banks often do. But once a transaction has been carried out, it's gone. And the combination of those two things makes it a very, very tricky and difficult scenario. So when we think about the setting of key protection, there are a number of different settings that we're actually referring to. The first is a type of custody setting. So here a company is providing protection for a long-term investment or something to that effect. It's not actually day-to-day usage, but large amounts held by large investors. And it's a pretty small turnover. And because it's a small turnover, you can actually have pretty complex transaction processes, and that banks and other financial institutions are used to in the custody solutions they provide for physical assets. But you do need to be able to get your funds out relatively quickly, so a very slow transaction time will also not be acceptable. Exchanges are a different setting. Here you have a very high turnover. You need to be able to speed up transactions. In fact, transactions today can take days. Weeks, typically not, but they can take days. And that's a very, very big problem for their business. There's a separation of vaults when it comes to exchanges. They often have larger vaults and smaller vaults, and they want different levels of protection for the different vault sizes. And this is also something that's crucial for them to be able to get the flexibility between fast or reasonable transaction times and a good protection. I just want to note that transaction time is one of the biggest concerns of, or balancing transaction time in security is one of the biggest concerns of exchanges today. And finally, there's another market for wallets, for end users. These are small amounts of funds. I won't talk much about the solution for wallets, but the same technology that I present is actually relevant for all three. So what are the requirements for any platform that will meet the needs of these different settings? Firstly, of course, we want high security, but it's important to stress what we actually mean by that. Security can mean many things, and here again I want to talk about protection against fraudulent key usage. Obviously, if someone steals your key, that the game is over, but even if they can use your key just once, it's the same thing, and therefore the focus has to be on usage and not on theft. Need to have backup and a verifiable backup to make sure that you don't lose funds because you don't have access. Fast transaction speed, which I talked about. And also flexibility to be able to fine-tune security and usability so that for different size wallets and different settings, you can get a different trade-off. And you also need to be able to support different coins, different signing algorithms, different standards, because if you're an exchange or you're a custody provider, you have to be able to integrate with everything that people are interested in. And you also have to be fast, agile enough to be able to update and support these new coins or algorithms and so on and so forth as they come out. So what are the existing solutions? The first one that I want to talk about is cold wallets or disconnected hardware. And the primary issue that arises with this solution is that of usability or speed. They're not flexible. You have very long transaction time. So think about an exchange that gets a request at 3 p.m. on Friday night, 3 a.m. on Friday night, Saturday morning to carry out a transaction. How long is it going to be until they can carry out that transaction? If they need 4 people to physically come and go into a vault to open the vault, that's probably going to wait till Monday unless they have shift times. And then they have significant employee dissatisfaction. So usability along transaction times is the main issue here. There are also security questions, which is how is that cold connection actually made? Cold sounds like a magic solution. It's not connected to the internet, so it's not a problem. But if you're using a USB drive, for example, to transfer the transaction information to the disconnected computer and get back the result, what guarantee do you have that no malware is being used to infect that disk on key and therefore the computer? So this is also not as simple as it sounds. Standard HSMs or hardware security modules are well accepted in the banking industry and in other industries to protect keys from being stolen. They're also not flexible. The primary shift in mindset that needs to be made is that HSMs are all about preventing key theft. Because the HSM will carry out the cryptographic operation inside and not export any keys. But if I manage to infiltrate the machine that's connected to the HSM and is authorized to carry out the transaction, then I can use the key just like the legitimate machine. So it's not, when it comes to preventing fraudulent key usage, it actually hasn't helped us at all. I just need to get to the machine that's allowed to use the key. Again, if I have an HSM that's not connected, I go back to the issues of the cold wallet scenario and everything that we discussed. Also, HSMs typically don't support many of the modern standards, and often vendors who are saying they're using HSMs to protect the keys for cryptocurrencies are actually encrypting the key material with a key inside the HSM and then decrypting and using. And once you decrypt the key and have it in the open, again, in a connected machine, this is a very problematic type of scenario. And transparency is also a really big issue when it comes to HSMs. Nobody knows what's running inside them, and the HSM vendors are not telling anyone. And this actually leads to scenarios where the security also becomes more questionable. At Black Hat this year, Ledger published an attack on one of the most well-accepted HSMs in the market. They were able to construct an exploit that enabled them to upload malicious firmware remotely and therefore extract all keys. Interestingly, once you upload malicious firmware to the HSM, you also cannot guarantee that any patch will take place, because if malware is smart, when you want to patch and update the firmware, you'll just say, yes, I've done that, and run that in a sandbox and actually continue running the malware and exfiltrate all the keys. So vendors would have, or customers would have to just hope that their HSMs weren't compromised. And I'm not bringing this to say, oh, HSM vendors don't know what they're doing and their software is bad and we know how to write software better than them. That's not my argument. My argument is that a non-transparent hardware model is not really something that is suitable to the mindset of this community, at least in my opinion. A third solution set is that of Multi-Sig. So you have multiple signatures which have to be presented in order to carry out the transaction. Unfortunately, it's not supported by all ledgers. So when we talk about broad support, it doesn't meet that criteria. It also is rather limited. You can't, or it's very expensive to have complex quorums that I'll talk about later on that you would sometimes want to define for protecting the currency, and also doesn't support some necessary operations like employee replacement. If you think about a custody solution or an exchange solution, so if I'm an employee at the exchange and I hold one of the keys in that multi-sig, if I leave the company and someone else comes to take my place, then we need to replace that key because I have had control over that key. The problem is that that would require us to transfer the funds. That's not something which is realistic to do in a commercial setting. So this also has usability limitations. It has limited security features as well. Something called proactive security isn't supported. Proactive security means that if an attacker slowly breaches the different key holders, then it shouldn't be able to get enough information to actually carry out a fraudulent operation. It would have to breach everyone essentially simultaneously in a single interval of time. That's not supported by Multi-Sig. The main advantage of Multi-Sig is its simplicity. It doesn't require any special expertise. If you know how to do basic cryptographic operations, you can also set up a Multi-Sig system, which isn't true of MPC, which I'll talk about next. So what's MPC, or Secure Multi-Party Computation? It's a well-researched area of cryptography. It's been around since the late 80s. There are thousands of research papers in the field. It was purely theoretical for the first 20 or so years. Recently, it has become efficient enough to use in practice. It's not just efficiency, but it's also the world has got to a place where MPC can really answer its needs, whereas 10, 15 years ago, we're in a very different place. It's a very active area of applied research, and improvements are continual, and it's a very open academic community, so we know exactly what we're getting. And the idea behind MPC is you can actually you can compute on private data without revealing anything. And the security guarantees are actually mathematically proven. So as long as the implementation is correct in terms of the protocol design, then you have a mathematical proof of security that you cannot break this scheme. So just as a toy example, this is the toy example that Yao used in the mid-80s. You have a group of cryptographers who are going out for lunch. They want the cryptographer who earns the most amount of money to pay for lunch. That happens to be Alice. You can see by their salaries, they're pretty poor. So they want Alice to pay, but Alice doesn't want to reveal her salary, and in fact, no one wants to reveal their salary, so they can run a protocol where they send messages to each other, and the result at the end is that Alice pays for lunch, but without anybody knowing anything. So that's sort of a toy example, but threshold signing is a specific case of MPC, which is relevant to what we're talking about here. So what is threshold cryptography? This is a special case of MPC for cryptographic functions. So if you want to encrypt, decrypt, sign, and so on and so forth, with a set of parties that come together, but no single or no subset of them, no unauthorized subset, is able to carry out the operation. It was studied heavily in the 90s, was abandoned for about a decade, and now has come back to life. And the way this works is you define a threshold. So you may have some n parties. You define m out of n, maybe 5 out of 7, 3 out of 8. You can define whatever you want. That threshold is called a quorum. And the private signing key is shared amongst all of the parties, but the security of the protocol guarantees that no subset which is smaller than a full quorum is able to carry out any operation at all. So you can't sign. Important security guarantees of these protocols are there's no single point of breach and failure. So even if a subset of the quorum is malicious and runs malicious code to try and attack the others, they cannot sign on anything that's not agreed upon. The parties participating don't just agree to sign, they also approve the actual message to be signed. So you can't have that we all agree to transfer funds, but we actually thought we were transferring $10,000 and one of the parties was corrupted and made it $100,000. No, if the full quorum doesn't agree on the actual message, that also won't be able to be carried out. And as I mentioned before, the security holds even if a subset of the quorum is malicious and can run any malicious code in an attempt to break it. They know the protocol, so on and so forth. And these are proven mathematically. So that's the idea of threshold signing. And it starts at secret sharing. So secret sharing is well known. You can share a key. Here we're talking about a cryptographic key. The private key is shared amongst the parties, and any subset of the parties can reconstruct. But no subset of less than that threshold can learn anything about the key. And one may think that this is very similar to threshold signing, and maybe we can just use basic secret sharing mechanism to get the same effect. So we have this quorum defined, and no subset can know anything, and only when you have a full quorum can you get the message, which is a private key, so you're safe. So how would you sign in this way? The quorum would come together, they would reconstruct the key, and then they would generate the signature using that key. The problem is that once you reconstruct the signature, you can now sign on a different message. So whoever actually gets that key can sign on a different message and can sign actually on an arbitrary number of messages. And in fact, as soon as it's reconstructed, you lose all protection. And that's fundamentally different to threshold signing, which uses secret sharing as a tool, but actually never reconstructs the key at any time. And therefore, you get the security advantages of secret sharing but without ever reconstructing, and therefore a full quorum is needed for every signature with validation of the message as well. So there are threshold signing protocols for all the popular elliptic curve signing schemes with support with security for malicious adversaries. That means, again, if the parties actually run malicious code, so we can support ECDSA, EDSA, Schnorr, so on and so forth. Any subset cannot sign. It supports also distributed key generation. We don't generate the key in one place and then split it up. But rather, even the key generation itself is distributed, so you never had to trust any single party or any subset of the quorum at any time, which is very important. It achieves also proactive security, which is what I mentioned beforehand, meaning that we define intervals, for example, an hour or whatever we want to define, and an attacker actually has to breach a full quorum within that interval to learn anything, because the sharing itself is refreshed and changed at periodical intervals. And that makes it very, very hard to carry out a full attack. It's also possible to define much more complex and flexible quorum structures than just saying I want 3 of 8. So we could consider sets of A, B, C, and D of different parties, and you could define a quorum in each set. And then you could define complex things like you need a quorum in either A or B, as well as in C and D. And where would this be very useful? Think about a custody scenario. You have a bank and you have a customer and maybe a trustee. And you would say that in order to carry out a transaction, you need 2 out of the 4 employees from the customer, along with 3 out of the 5 at the custody provider and 1 out of 2 at the trustee. And this enables you to ensure that no single organization could actually transfer the funds. And this is all, of course, cryptographically enforced inside the threshold signing protocol. Even in exchanges, you could have situations where for larger amounts, you would require a quorum in 2 different subsets, and you can actually define the quorum to be flexible and depend on the operation you want to actually carry out. So complex quorums with many parties for very large transactions and large wallets, smaller quorums with smaller numbers of parties for smaller transactions, and even automatic bot approval if it's very small transactions, so you don't have to involve humans, and that enables you to get this flexible trade-off that I mentioned beforehand between security and transaction time. In addition, you can define 2 types of parties, what we call online parties who actually run the MPC protocol. They have to be simultaneously connected. And the humans that are involved in providing authorization or approval for the transaction, they can actually do this asynchronously. So if someone's in a train or at a meeting or on the other side of the world and they're sleeping and their phone is in airplane mode, then we don't have to try and get everyone to be simultaneously connected, but as soon as a quorum receives notification and says approve, and then provides their parts of their participation in the MPC protocol, then the transaction is approved and it can go forward. So this is very, very much enables us to provide the needs of exchanges and custody providers and so on. We can also support standard key derivation. So if you wanted to use BIP derivation, for example, which requires computing a hash function like SHA-256 or SHA-512 on the secret key, but no one holds the secret key, so how can you do that? Well, fortunately, MPC can also support that. I do want to mention that MPC is not trivial necessarily to actually deploy securely. For example, MPC doesn't enforce anyone to use a correct value. You can actually input anything you like. So what happens if you input something incorrect? If it's part of a signing protocol, that's fine. The signature won't verify at the end. It will fail. And the protocol actually will even detect who did that. But if we're doing key derivation and you've backed up the master key, I can, by inputting garbage, I can actually make us derive a key that won't be retrievable from the backup. So we need to add a mechanism to the MPC to enforce that it's actually correct, and we do that. But the general comment that I want to make in this slide is just that MPC is unfortunately not yet an out-of-the-box technology. It requires considerable expertise. That expertise is known to the community and is becoming more and more known also in the commercial setting and industry, but one still needs to make sure that that expertise is given from whoever is deploying the MPC solution. I mentioned proactive security. This is a refresh secret sharing A Shamir secret sharing is typically what is used, at least for the basic thresholds. That's based on having a random polynomial that defines the secret, and you can refresh and completely change that sharing by just adding a random zero polynomial. So, and this is all done in MPC. Likewise, I mentioned party administration. We want to have an employee may leave, new employees may join. This is all supported by the MPC by resharing amongst the new set depending on the change. As I mentioned beforehand, this is a lot of this comes out of is research which is being done. It's public research. The papers are in the public domain and can be inspected and reviewed. Here's just a list of some of the papers that are out there. There are also some open source repositories presenting these solutions, at least for some of the limited settings. We have one which can be used for wallets. Zengo also has an open source solution. The other more enterprise solutions we have are not open source, but they are based on peer-reviewed and independently reviewed publications. So in summary, some of the important features that we can get from an MPC solution is fast transaction time. It's in software, so it doesn't require physically coming to a certain location. It supports asynchronous approval, secure backup, party administration. This is all important also if you're an exchange, for example, to not have your employees have to be working at 3 a.m. on Friday night or Saturday night. And a combination of threshold signing and MPC can support and provide a comprehensive platform that will give protection not just against key theft but also key usage through this Quorum authorization, which I want to stress is cryptographically enforced. It's not I provide a password, so if I go to the server who's supposed to validate that password, I can bypass it, but it's fully incorporated. It's suitable for the full entire spectrum of wallets, custody, and exchange. Includes verifiable backup, and all of the operations needed like key generation, signing, and so on and so forth. And this is not although it's new to industry, it's not a new technology. It's based on 30 years of research in academia, which is now mature enough to be used in practice. Thank you very much. Yeah, if you have any questions, I'll be happy to take.
Hi. So if I understand correctly, the way to steal the private key is to breach the full quorum, right? How is it different from, in Multi-Sig, breaching all of the parties and stealing each private key?
Yeah. So the main differences are, firstly, in principle, Multi-Sig and MPC have a lot in common in this the ability to define the quorum. In most platforms, it's very expensive, and sometimes it's not even possible. Not all coins support Multi-Sig, and even when they do, it's expensive to have a complex and large structure. That's number one. Number two, Multi-Sig doesn't support proactive security, so you can't refresh the sharing. If I slowly breach, if it's a 2 out of 3 multi-sig or even a 5 out of 8 multi-sig, it might take me 6 months to breach the 5 parties, but once I've done that, I can take everything. With MPC, you can run a refresh every hour, and you actually have to breach all 5 within the same interval. That's the main difference.
Hey, question.
Yeah.
Right here. Thank you. You said that there is expertise required to use MPC right now. What are the biggest mistakes people are likely to make if they don't have specific knowledge of MPC technology?
So one of the examples is the one that I said in terms of knowing that understanding that if you have to enforce inputs, that's something which is not out-of-the-box MPC. Another is that if you want to take something which is an out-of-the-box MPC protocol, to read it from an academic papers often leave out a lot of details. You have to really understand. They won't tell you things like verifying that a point is on the curve. That will be just something they assume you understand. So you have to understand really what's going on in the language of an academic paper. And if you're doing something which is not exactly in an existing paper, and often you need to do that because you need to do something slightly different, then you have to have enough understanding of MPC to actually do that. So today I would say that you need to have significant amount of MPC expertise to do something which is new. To take something out of the box is less difficult. And you have to make sure you're really doing exactly what was prescribed beforehand.
For many applications, there's a value of having the master public key well known. which means that proactive refresh will make it difficult.
No, the public key doesn't change in refresh. What happens is the sharing of the private key changes. The private key stays the same. The public key stays the same. It would be impossible to change the keys. But the sharing of it, so it's a polynomial in Shamir sharing, where polynomial P, where P of 0 equals the private key. And each party has a different point on that polynomial. Now generate a different polynomial, a different random polynomial with the same 0 point, and then that's a brand new sharing. If you get some of the shares from the previous polynomial and some from the new polynomial, it's completely meaningless.
And you need to verify that each party deleted its own
That's part of, yeah, well, that's actually the easiest thing out of everything, yes.
Thanks for a wonderful is this thing on?
Yes, I can hear.
Wonderful, thank you. I can't hear myself. It's incredible. I'm Boris from Trustology. I work for key management. This looks wonderful. I'm trying to understand from this position in MPC, how long do you think it will take and what it will take to get us to adoption in, let's say, DeFi or regulated industry?
It's firstly, it is being adopted. We are working with some of the largest exchanges in the world. They're using our solution now. We are using our solution as possible to protect exchanges, for example, using now custody providers are looking closely, but that's a slower process. There's still regulation. Sometimes, for example, regulators will say you need to have something called. So one of the shares of on one of the parties in our solution can be called in places where regulators require that. In many places, there isn't a problem with regulators, and they're fine with using an MPC solution. So this is actually mature technology, and it is being used today, and not just previous weeks. We've been in production for quite a while. Thank you very much.
Thank you.